Hey everyone, welcome back to Corporate Decoder, the place where we unravel the hidden stories in financial filings, and tonight, we're diving into a company that has been dancing on the edge of Nasdaq delisting but might just have pulled itself back from the brink.
We're talking about Yunhong Green CTI Limited, or CTI as they call themselves. And their latest report details a pretty nail-biting situation with their stock price. Imagine the company's stock is like a car and Nasdaq has a minimum speed limit it needs to hit to stay on the highway. CTI's car sputtered and dropped below that speed limit.
And they were given chances to fix it.
Now, the big news here is that as of the 15th of October, CTI got a notice from Nasdaq saying they've actually met that minimum speed limit requirement again. Phew. But how did they get there? It was a real roller coaster. Let's rewind. Back in October of last year, Nasdaq told CTI they were in violation. Their stock price, the amount people were willing to pay for each share, had dipped below $1 for 30 days straight. This is a big deal. Nasdaq wants to see companies with a certain level of value and stability.
A persistently low stock price can signal trouble for investors and for the company itself.
Nasdaq gave them an initial grace period of 180 days, about 6 months, to get their stock price back up to at least $1. Normally, if a company can't do this, their stock can get actually delisted, meaning it is no longer traded on the Nasdaq exchange. That is a massive blow to a company's reputation and its ability to raise funds.
But here is where it gets dramatic. CTI couldn't fix the problem in those first 6 months. They were still below the dollar mark. So Nasdaq, showing a bit of leniency, gave them another 180 days, pushing the deadline to the 19th of October of this year. Talk about second chances.
So what did CTI do? They decided to do a reverse stock split. This is a move where a company reduces the number of outstanding shares, but it artificially inflates the price. Per S-hair. In this case, they did a 1-for-10 split. Think of it like this: if you had 10 $1 bills, and you exchanged them for one $10 bill.
The total value is the same, but you have fewer bills and each bill is worth more. They got their shareholders to agree to this on the 22nd of August. This reverse stock split officially happened on the 1st of October. And just like that, their stock price magically jumped up and they were back above that dollar mark that Nasdaq requires. This explains how they met the requirement by the 15th of October. It is a clever financial maneuver, but it doesn't necessarily mean the company is fundamentally doing better.
It just makes the stock look better on paper for listing purposes.
This notice from Nasdaq on the 15th of October is essentially them saying, okay, you did it. You are back in our good graces for now. But it is crucial to remember that this compliance was achieved through a stock split, not necessarily through a surge in underlying business value or profitability. The company's main product here is its common stock, Connecticut I. It is traded on the Nasdaq Capital Market, which is Nasdaq's own segment for smaller companies. While gaining compliance is a win, the real question is sustainability. Can they keep that stock price above $1 organically now, or will they face this issue again? Looking at the filings, we see the main security registered as their common stock, traded under the symbol YJ. This is what investors are buying and selling. The whole drama we just discussed is about the trading price of this very stock. And this report is signed by Jana M. Schwan, who is the Chief Executive Officer. Ultimately, she is the one responsible for steering the ship. Getting back into compliance is a short-term win, but the long-term health of the company is what truly matters. So, what is my take on this?
Yunhong Green CTI Limited managed to pull off a technical compliance with Nasdaq's minimum bid price rule. This is a short-term victory that prevents immediate delisting, which is good for investor confidence and potential future fundraising. However, the method used was a reverse stock split.
This is often seen as a cosmetic fix. It doesn't magically make the company more profitable or its underlying business stronger. The real challenge for CTI will be to generate enough business growth and profitability to naturally sustain its stock price above the $1 threshold without resorting to further financial engineering. Without that, they could find themselves in this predicament again. The risk is evident.
If the business doesn't improve, the stock price will likely falter again, and another stock split might not cut it next time. The company's direction is focused on survival in terms of its stock listing, but the ultimate goal should be sustainable business growth. Keep an eye on their future filings to see if they can translate this compliance win into real, tangible business success. All right.
That is our breakdown of Yunhong Green CTI Limited's latest filing. What is your take on these numbers and what they signal for the company's future? Do you think the stock split was a smart move or a sign of deeper issues? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description for even more exclusive content and discussions. Thanks for watching. See you next time.